Hey there, it's Mike Wise, CMG Home Loans, and your weekly mortgage update. A couple of things we're celebrating today. Today is my 33rd wedding anniversary to my wife, Kristen, so happy anniversary. And also, we are celebrating at CMG Home Loans 20 years with the All-in-One Loan. So 20 years of a product that is a very, very, very creative product to help people pay off their homes way faster, save hundreds of thousands of dollars in interest, and retire without a mortgage payment. So a lot of people super happy with this loan. Zero delinquencies, zero foreclosures on this product. It is an amazing product. We've had a good run with it. If you're interested in learning more about it, let me know. As far as mortgage news, let's take a look at what's happened this week with the market. So, light at the end of the tunnel, the inflation numbers. They're coming down. The numbers are starting to come down. We're starting to get to that 2%. Let me mark this up here. We're starting to get to the 2% target that the Fed is wanting to get to. So we are absolutely real close to those numbers. The personal consumption expenditures, they rose just 0.1% month over month, and that brought the headline down to 2.1% year over year, and the core was down to 2.5%. So those numbers you can see here, they are trending down, and so we are seeing the inflation numbers slow down. So prices are not going up as fast as they were. Housing out there, it is slowing. So the numbers are showing basically it's slower growth than normal. Annual price growth slipped from plus 2.5 to plus 2% year over year. But I don't think we have to worry about it. I think that we're still having a housing shortage, and there's still a lot of people out there looking for houses. Mortgage rates are probably the number one reason as to why that is happening. But I think people are getting used to these rates, and they're coming up with, we as an industry are coming up with ideas to help you actually get your payment a lot lower for maybe the first 2 years, the first year, or we're doing permanent buy downs with seller concessions. So because the the price growth is slowing, the number of houses are slowing down as well. So JOLTS is the job openings and labor turnover. So at the end of the day, they were expecting a decline, but it was up 200,000 job openings. So that's not great news for the economy because there's a lot of jobs that are open out there, but they're not getting filled. So the quits rates and the hire rates, they're pretty low here. Now, ADP came out this week with their number for the jobs that were created. That was abominable. It was terrible. It was 37,000 jobs that were created, and they were expecting 120,000 plus jobs to be created, and there was only 37,000 jobs. Now, this is ADP. The number came out this morning with the BLS report. So we'll, in fact, let's take a look at that here. The BLS, they were expecting 130,000 jobs, and let's go to here and show you that basically this is the headline this morning, that 139,000 jobs. Now, it does say here in the headline that the hiring slowed in May. So that is why we're looking at those numbers. It is still not great because it is slowing, but this was above the estimates of what everybody was expecting, and the unemployment rate held steady at 4.2%. So in the beginning of the week, we thought with the ADP report that came out that you were going to see some improvement in the mortgage rates. We did see the improvement, and I'll show you that in just a second. And we thought that that was going to have an impact on today's numbers from the Bureau of Labor Statistics, and that came in hotter than expected. Payroll numbers, the incomes were starting to go up as well. So a lot of kind of information. In fact, let me show you. This is another article in the Wall Street Journal, and basically economists are raising questions about the quality of the U.S. inflation data. Well, this is also the jobs and the inflation numbers. And so this article, you can go through and read it, but basically they're talking about the accuracy of these numbers, and it's a very touchy situation, because what happens is these numbers come out when they report these numbers, whether it's inflation or employment, which are huge numbers that the Fed relies on to dictate where the rates are going to go, as well as the market. So the bond market, the stock market, they all rely on these numbers, and just little changes impact the market huge as to where the economy is going and what they're going to do. And these numbers, they're not accurate. There's huge revisions every month, and so when we see those huge revisions, it's a problem. And basically, they're guessing. So a lot of the time they're guessing here, and they are not right. In fact, we've seen a lot of those revisions. There's 2-3 revisions afterwards for these reporting data, and the Bureau of Labor Statistics is basically saying, yeah, we're understaffed, and so we're doing more guesswork on this. So that is not great news for what we're looking at here. So inventories, housing inventory. Now is a great time to buy a house. It is the lot of the sellers. There's a lot more inventory on the market, and so the buyers have a little bit more availability, more picky to be able to get what they want. And so I've seen a lot of negotiations where there's seller credits to help buy down the interest rate, because there's more inventory and there's more competition, and people are wanting to get those houses sold. So it is interesting how the market is shifting a little bit here. And then the last thing I wanted to go over, this is 99% probability that the Fed is going to not lower the Fed funds rate next on the 18th, and on the 30th it's a 70%. So it really depends on what happens in the economy over the next couple of months here. So let's go to the market. I'm going to show you a couple of things. So right now we're on the yield. And you can see, I'm going to do some numbers here. So this is, again, yield is going down here. So down is better. And so on Wednesday, we saw, this is the ADP report came out, and the yields went down. They went below the 100-day moving average, they went below the 25-day moving average, and they went all the way down to the 50-day moving average. So they broke through to and stopped at that moving average there. Now I'm going to erase this, but that's where they kind of hit, is that 50-day moving average there. And then yesterday we saw a little bit of an increase in the yield, not too much, but it came back up to that 100-day moving average and kind of hit that. This morning the numbers came out for the employment numbers, and it blew right through those numbers again, and so now we're tapping out there at 4.46% on the 10-year yield. So mortgage rates, they went down. We were seeing 6.85% was kind of the number that we were at, and now we're starting to see it a little bit higher than that. So same thing on the pricing. You can see the numbers. The pricing higher is better here. Right, we came all the way up to the 200-day moving average on that, and then yesterday we retreated a little bit, and then today we went back down. We're going to end up right there. I think this is probably where we're going to end up for the weekend here. But yeah, interest rates, they went down. They started to come back up this morning. In fact, let's look here one more time. See, so we were at 6.85 as of last night. This morning we're at 6.89. It's up just a little bit here, so you can see the negativity of the trend at this point in time. So that's the news for the day, or for the week. Hope that you got some information there for the weekend. But this is Mike Wise with Mortgage Wise and your weekly mortgage update. Check me out on YouTube. Learn about the all-in-one loan and what an impact it can have for your clients. I will see you next week. Hope you have a good weekend.